Good morning, ladies and gentlemen. The Matthews and Goodman UK property market webinar will start in about 1 minute's time. So please just bear with us whilst everybody's loaded into the webinar. Thank you. Ladies and gentlemen, the webinar will start in about 30 seconds time. Good morning, ladies and gentlemen. My name is James Routledge, and on behalf of everyone at Matthews and Goodman, welcome to our annual review of the UK property market. If I thought last year's backdrop to our annual briefing was tumultuous, how wrong I was. Let us put Partygate, the impending tax increase, the energy price hike, highest inflation for 30 years, base rate increases, and the resultant cost of living crisis, let us put all of that to one side. What does post-pandemic Britain look like economically, financially, and of course, for our own sector? The truth is, post-pandemic Britain has to be cognizant of developments on the wider international stage because, to misquote that old adage, when the developed world sneezes, Britain catches a cold. Elections seem to dominate the international agenda. China is due to hold one in March. The US midterm elections will be later this year, as will the French presidential elections. And of course, we have our own local elections in May. Why are these important? Because politics impacts the economy and economic strategy impacts all of us on this webinar. Before I introduce our two speakers, I'd like to point out that there will be an opportunity to raise questions and/or issues, observations and insights whilst they are speaking by simply using the question box on your screen. There will be a Q&A session at the end of the presentations, and any questions not answered during this live session will be addressed after the webinar. I'm now delighted to welcome our two speakers, both well-respected experts in their field. David Smith, Economics Editor for the Sunday Times, and Mark Long, Head of Strategy at Orchard Street Investment Management. Let me kick off with a quick word about David. David is the multiple award-winning journalist and author of 8 books, and of course, the thing he is primarily known for, the long-established economics editor for the Sunday Times. He is also the chief leader writer, assistant editor, and policy advisor on the publication. To highlight the breadth of his expertise, David's books have ranged from Mrs. T to The Dragon and the Elephant, which focuses on the rise of China and India, and poses fundamental questions about both the structure of the world economy and the balance of global geopolitical power. In particular, how the world is tilting eastwards and what the implications of the shift in global power to Beijing, Delhi and Washington will be. And within the context of today, what the implications are for the markets in which we operate. Our second speaker, Mark Long, is the Head of Strategy at Orchard Street Investment Management, which has around £4 billion of property assets under discretionary management. Orchard Street manages accounts for some of the world's largest pension funds and wealth management clients. I've known Mark for a number of years, so I know personally that his first-class reputation is well-founded. I'll be particularly interested to hear Mark's views on the prospects for property in an environment of high inflation and whether officers will rise up his buy list now that city centre buzz is back. Finally, ladies and gentlemen, let me spend a moment providing the context for our two speakers. Net zero, ESG, our green industrial revolution, hybrid working, structural changes within the markets we focus on, buildings designed and or adapted to address the issues related to the inevitable recurrence of contagious pandemics and climate change. This is the context of the world we all work in. How will this affect what ties us all together? Property. Here to help us navigate our way through this maze are our two expert guides, David and Mark. David, the floor is yours.
Thank you very much, James. It's a great pleasure to be talking to you this morning. This is a fascinating time in politics, as you suggested. It's also a fascinating time for the economy and the economic outlook. In politics, I think the unusual thing about Boris Johnson is that I don't think he has that many close friends, but he has many acquaintances, particularly among journalists. I first came across Boris some decades ago when he was a colleague on the Times, briefly, because he was sacked for making something up. I don't know whether that set the scene of what might be to come later. I've also got to know Rishi Sunak quite well in recent months, in a couple of years since he's been Chancellor, and he's still very young, but he's got probably one of the most impressive grasps of detail of any politician I've come across. So that may set him in good stead for the future. We shall see. Anyway, I want to talk about the economic and business outlook. As I say, it's a fascinating time, and there's plenty to talk about. What I wanted to try and do was to answer 4 questions. I've set myself 4 questions on the principle that it's always easier to answer questions that you've set yourself. So it's the recovery. I mean, obviously we're in the middle of a post-pandemic recovery at the moment. A little bit of a pause as a result of Omicron, maybe, but certainly we're still on the way back from the coronavirus hit. Inflation and the cost of living, as you suggested, James, is the big story of the moment. And I think the big story there, which I'll come on to in a second, is this going to subside? You know, we know from the Bank of England and others that we're going to get 7% inflation or so this spring. Is that as bad as it's going to get, or could this inflation become ingrained, which would be more problematical? Interest rates and the response to that, we've already seen a couple of responses from the Bank of England. We'll shortly see some more from the Federal Reserve. And I mentioned Rishi Sunak. He's already announced significant tax increases. Will there have to be more to put the public finances back into good shape? So those are the issues I want to talk about. But there are plenty of others, some of which may come up in questions. And one of which, of course, was the subject of a white paper last week, the Levelling Up white paper. Is that meaningful, or was it just a lot of verbiage? Are we going to see a genuine levelling up? This is something that politicians have been grappling with for many decades. Business rates, can we really be a high wage economy if we don't have a high productivity economy? Those kind of things we may discuss a little bit later. But anyway, let me come on to my theme, starting big with the global economy. And I think the picture for the global economy is reasonably reassuring. I mean, what we're seeing at the moment is a good global recovery. We saw good growth in 2021 globally, and I think that is going to be also the case for this year, for 2022, and to that extent, by the same token, for next year. So I think prospects for the global economy are pretty good. This is the most recent IMF forecast, and it's pretty much in line with other forecasting institutions that the growth prospects for this year are pretty good for particularly for advanced economies. You know, the developed world is doing pretty well, and that may be a vaccine story where the vaccine rollout is highest. Then prospects are probably best. I mean, a couple of years ago, none of us would have thought of talking in these terms, but in that respect, coronavirus has changed things. So a pretty good global outlook, I think. But within that, one of the big stories is that most countries are doing pretty well. You'll see the UK prospect there, at least according to the IMF, is for this year is good. And as the government keeps saying, on this forecast, we've got the fastest growth. We had the fastest growth in 2021 of G7 countries. We are on target, according to the IMF, for the fastest growth in 2022. Of course, having suffered one of the biggest declines in 2020. I was rather miffed when, as a result of revisions by the Office for National Statistics, the rather endearing comparison that we'd suffered in 2020, the biggest drop in GDP since the Great Frost of 1709, was actually pared back to, 2020 was only the biggest fall since 1921. It's still quite a long time, of course, but not quite as momentous as 1709. But big fall in 2020, good recovery in 2021, and a good recovery continuing this year. Although some forecasters, including the Bank of England, are a little bit less optimistic about that, and they, as you may have seen, revised down their forecast last week. I'll come on to that in a second. I think the interesting story, I mean, James mentioned, my interest in China and India, and the Chinese growth story has been phenomenal over the past 3 or 4 decades. From the late 70s, from about 1977 until pretty much now, the Chinese economy has grown by an average of 9.5% a year. And we thought of China as a 10% growth economy. We thought it was only a matter of time before it overhauled America in GDP terms. But these days, China has now turned into a 5% growth economy, still pretty good, but the closer it gets in terms of convergence to the West, the slower the growth becomes. And China has got some significant problems at the moment. Some of them, those arise from the property sector. Some of them arise from its attempt to achieve net zero COVID, which many scientists would say is impossible. Most countries would think we have to live with it as an endemic disease, and so there is a bit of a question mark about when China will become the biggest economy in the world. It was considered to be a pretty safe bet that would happen about the mid-2020s, but now that is being pushed out as a result of this Chinese slowdown that we're seeing. And in general, as I mentioned, advanced economies are doing relatively better, not absolutely better, but relatively better than the emerging world. For the UK, the interesting thing about the bounce back is, and this just reflects the highly unusual nature of the pandemic recession. The pandemic recession was caused by 2 factors. One, of course, was lockdowns and restrictions. The other was changes in voluntary behavior. People started to adjust their behavior when the coronavirus emerged, and lockdowns reinforced that. But normally, it takes 3 years to get back to a pre-recession level of GDP, and we're talking usually in recessions about a much smaller fall in GDP than we saw during the pandemic. Just to set it in context, what happened in 2020, in the spring of 2020, the second quarter of 2020, the period of the first lockdown, we saw GDP fall by nearly 20% during that quarter. And to put that in context, the biggest post-war quarterly fall in GDP before that was during the 3-day week in 1974, and the fall then was 2.7%. So nearly 20% versus 2.7%. And on average during the financial crisis, the quarterly falls got no bigger than 2%. So this was a momentous fall in the first lockdown. Subsequently, we got better at handling lockdowns and adjusting to them, and so the subsequent lockdowns had much less of an effect. But to get back to where you were in 2 years compares with a typical recession recovery period of 3 years and 5 years in the case of the financial crisis. Took 5 years to get back after the financial crisis. So this is quite quick. Business confidence took a little bit of a knock as a result of Omicron, as you can see there, and as a result of the increase in inflation and business costs, but seems to be recovering a bit now. So I think businesses have come into certainly the later part of January and now in a more optimistic frame of mind. So that is a good thing, and that bodes, I think, quite well for investment prospects. But consumers are still pretty cautious. Consumer confidence is better than it was at the low point of the pandemic when people were really worried. But consumers are still a little bit wary, and you may say that there are good reasons for that. I mean, this was what the Bank of England said last week. You may have seen this; it was in the headlines that we are in for the biggest drop in real incomes since, it says since records began, and a lot of these comparisons of when, since records began have to take into account the fact that these particular records didn't begin till 1990, so it's not an all-time record, but this is quite a squeeze on real incomes that we're seeing as a result of the cost of living crisis. It is called the cost of living crisis for good reason. And this was I asked the question, a couple of weeks ago in one of my columns about could the economy grow when the cost of living squeeze is biting so hard in an economy like ours, which relies heavily on consumer spending. And I think the Bank of England provided part of the answer last week in revising down its growth forecast to a bit below that IMF one I showed earlier. So they think the economy will grow by a little bit less than 4%, which is still pretty good, but less good than it was expected to be. And that was entirely the result of the cost of living squeeze, and that seems to me quite logical. But I don't think we should despair too much. I mean, if you look at the labour market, and we've seen an astonishing recovery in employment. Self-employment is still down on pre-pandemic levels. A lot of people have moved from self-employment into employment. The employment numbers are very strong at the moment, and so are the vacancy figures. I mean, vacancies, as I always say, are a little bit easier to post in these online days than they used to be. I still have great nostalgia and great financial nostalgia as a Sunday Times employee for the days when we used to run very large appointment sections, executive appointment sections, sometimes stretching to 28 pages. Sometimes there are so many executive appointments we had to have 2 sections in the same week. And of course, all of those have migrated online now to with an adverse effect on our advertising revenue. But of course, it's more efficient, it's cheaper. But even so, the number of vacancies in the economy, more than 1.2 million, almost as many vacancies as there are people unemployed, is quite astonishing. And that shows an underlying health in the economy and in the labour markets. And as a result of that, this is the Bank of England's chart for growth. And the recovery, the trajectory is still upwards. This is what is known in the jargon as a fan chart, in which they produce a range of outcomes. I always say that this is a great way of doing forecasts because you can never be entirely wrong, but it shows the broad picture that the growth will continue, that the upturn still has plenty of legs. And I think that is an optimistic view, and it's a justifiably optimistic view. I think we should expect some more recovery, at least for a while. I do have some worries about what happens after the pandemic bounce, but for the moment, I think this year looks pretty much set fair. So I think there's reasons for optimism about that. What about COVID? I think the story there is, in some ways, when it came to the second half of last year, we learned to live with, we accepted high case numbers. When Omicron came along, we were glad that it was milder in its effects. And, the hope has to be that there are no nasty new variants out there, and that that the pandemic is now on its way out. I mean, the cautious thing we have to say is, we may have thought of that several times during the course of this pandemic, but I think there are better reasons for thinking that now than there have been before. So I think on my first question, I think the recovery globally and the UK is still pretty well established, and there's a way to go on that. What about inflation? I mean, I think inflation has been the real surprise, and that just underlines the unusual nature of the recovery and the recession and recovery. Normally, if you have a recession, then the aftermath of a recession is lots and lots of spare capacity, which keeps inflation low. And one of those parts in which you get spare capacity is in the labour market. So I know from talking to him that the Chancellor, when he established the furlough scheme, his hope was that this could stop unemployment from being too high in the wake of the pandemic. The last thing he expected was to emerge from it with labour shortages and with a very tight labour market, which we've got at the moment. That is reflected in other countries as well. In America, they talk about the Great Resignation. We've got an element of that in the UK with people having dropped out of the labour market. Of course, we don't have as many EU migrant workers either. So the inflation coming back, some of it reflects these supply chain difficulties, some of it reflects unexpectedly tight labour markets. But, a year ago, and I looked at this quite recently, pretty well nobody was predicting the kind of inflation that we've got now. It's not just the Bank of England that missed this. Pretty much every forecaster didn't expect inflation to be as high as it is now, let alone going, substantially higher as we move into the spring. So it's everywhere. It's in every measure you can look at, and it's in every country. UK inflation, the latest figure is 5.4%, or if you prefer it on the RPI, 7.5%. But as you see here, that is in line, or even in some cases slightly lower than the average among Western industrial countries, the OECD countries. So everybody's got high inflation, and for similar reasons: supply chain problems, energy price rises, and so on. So it is a global phenomenon. I think some countries are dealing with it differently than we are. You may have noticed that France has put a 4% cap on energy price rises, but every country is experiencing an inflation problem. Business costs are going up a lot. Raw material costs are going up. You see that in the construction industry. You see it in other sectors as well. This is a real difficulty. And, the worry is that this becomes ingrained, that even if you don't have a wage price spiral, you get a kind of cost and price spiral. So, so it could take a little bit before some of these things drop out. But at the same time, there are good reasons why some of these things are temporary. I mean, it does seem that some of the supply chain difficulties are beginning to ease. I think we're seeing a little bit of the easing back of some of those shortages in the labour market, and also, some of the unusual features in the inflation figures. The fact that second-hand car prices have shot up enormously because chip shortages are affecting the supply of new cars, and in some cases, second-hand vehicles are selling for more than the list price of new ones. That is unusual. It's distorted. It's not going to last very long. So I think there are good reasons to think that the inflation, while it is nasty, is not going to be at the same level we'll have in the first half of this year for that long. It should subside as we move into the second half of the year and beyond. But as long as it's around, it's quite nasty. House prices, of course, one of the really unusual things about the pandemic was what happened in the housing market. Normally, when the first lockdown happened in the spring of 2020, housing market was closed, and you would have expected a standard housing market response to a big recession. In other words, a fall in house prices, a fall in activity. Instead of which, for various reasons, the stamp duty cut, very low interest rates, and people wanting to relocate because of working from home, we've seen this mini house price and housing activity boom. 2021 was phenomenal for transactions as well as for prices. So this is unusual, and it hasn't subsided yet. We've still got house price inflation in double figures. So this is unusual. What about interest rates? This is a dog that hasn't barked much recently. This is actually a real dog in my garden, and he does bark occasionally. But we've got used to interest rates not changing very much over time. It took years before the 0.5% bank rate level established in the wake of the financial crisis to move at all. It didn't really move until the Brexit referendum. So to have interest rate changes now of the sort we've seen quite recently, back-to-back interest rate increases by the Bank of England, which you see here, one in December. There wasn't a meeting in January. There was last week. We saw another rate rise. We haven't seen that for 17 or 18 years. Last time this happened was in 2004. It reflects the fact that the Bank of England knows it got caught out by inflation. It knows it has to make a response to it, even though it still thinks that a lot of the causes of this are outside its control. They're international. So I think we're now in a period of rising interest rates. The question being, where does this stop? And I think the answer to that at the moment, there are two things that the Bank of England did last week. One of which was to raise interest rates to 0.5 percentage point, although it was a narrow squeak about whether they could have gone up a bit more to 0.75 percentage point. As it says here, 4 of the MPC members wanted a bigger increase, but it also moved from QE, quantitative easing, which has been supportive certainly to the housing market and to other asset markets, to QT, quantitative tightening. In other words, reducing the size of its balance sheet, reducing its holdings of gilts and of corporate bonds. The Bank of England has got 895 billion of QE on its books. 875 billion of that is gilts. 20 billion of that is corporate bonds. 20 billion of corporate bonds will be run off by the end of next year. The rest, the gilts, will be run off gradually by not reinvesting the proceeds of maturing gilts on its books. But this is a big change, so the two things taken together represented quite a significant moment for the Bank of England. But I think it's important to say that I think we're in the context still of very low official interest rates. In other words, you think back, and many of you will have memories of much higher interest rates than this. The average level of what we used to call minimum lending rate, but is the equivalent of bank rate in the 1980s, was 12%. The average from the early 90s until the financial crisis was 5%. I think and when the Bank of England cut bank rates to 0.5% during the financial crisis, it was taking us into new territory. The Bank of England's been around since 1694, as has bank rate, and until the early part of 2009, bank rate had never been below 2% through wars, plague, pestilence, etc. So getting it down to 0.5% and keeping it there was pretty extraordinary. I think we're still in that. I think we'll go above the post-crisis low, so we'll go to 1, 1.25, 1.5. But I still don't think we're heading back to 3%, 5%. I think the bank thinks that that kind of level of rates, 1.5%, will be enough when the international factors that have pushed up inflation start to subside. But as I say, this is still quite significant in terms of a tightening cycle of the sort we haven't seen for more than a decade. What about the Chancellor? My new acquaintance, Rishi Sunak. Last year was a phenomenal one for announcements of tax increases. Corporation tax will go up from 19 to 25%. Income tax allowances and thresholds frozen from April, which, when this was announced in early March, this wasn't seen of as particularly dramatic, because of course when it was announced then, nobody expected inflation to be 6 or 7% in the spring. But freezing allowances and thresholds at a time of 2% inflation is not too painful. Freezing them when inflation is 6 or 7% is pretty painful, brings more people into tax and so on. Same with national insurance. I mean, you would not have decided on these things had you known how high inflation was going to be in the spring. But a big increase, the biggest set of announcements of tax increases that we've had in a very long time, in an effort to fix the public finances. So this was very dramatic. His aim, of course, is to stabilize debt. This is one measure of debt. There are two measures of debt. One excludes some of the things the Bank of England does, including what's known in the jargon as the term funding scheme. This is the lower measure. The higher measure essentially takes everything into account. And the effect of the pandemic was to take us from government debt of 80% of GDP to about 100%. And that's the equivalent of adding about 400 billion to the national debt, to public debt. And the Chancellor's aim is to stabilize that relative to GDP. And he also wants to, and I'm a bit skeptical about this, wants to be able to cut taxes by the end of the Parliament. I think this is quite this is looking to be quite a stretch, I think, given the other pressures on the public finances. But I think it's better to have a Chancellor who has ambitions to cut taxes than one who doesn't. But that is his ambition to do so. But he'll need to do so if the tax burden, the taxes as a percentage of national income, are not to rise to their highest level since the Attlee government was still in power in the early 1950s. So pretty dramatic to a tax cutting chancellor, instinctively tax cutting chancellor, who's presiding over the highest tax burden for more than 70 years. So this is this is ambition. We are at the moment, heading into higher tax territory with all of those increases that were announced in 2021 yet to come through. But I think the big picture, there is unfinished business here. I mean, at one stage, the Treasury is very keen to equalise the tax treatment of income and capital gains, in other words, to tax capital gains higher. There are issues about green taxes. I mean, one of which, as you all know, is how do you replace petrol and diesel duty if everybody's driving electric cars? So there are these challenges and reform challenges, I think, that are still to come. But I think it's pretty basically the case that there won't be any new tax increases this year. All the pressure is in the opposite direction. Quite a lot of pressure was on to cancel the national insurance increase. So I don't think we should be too worried about further tax increases this year or next. I don't think that's going to be the case. So that's reassuring. And to offer additional reassurance, I'll just end by updating you on I've given you lots of economic indicators here, but I'll just update you on my own favorite proprietary economic indicator, which is the SKIP index. And I'll just add another index to it, if I may. The SKIP index, for those of you who've never seen it before, is I've been following this for years. It's based on a number of builder skips in my street. When there are none at all, there's no growth, or we're in a recession. When there are two, the economy is growing in line with what economists call trend growth. And when there are four, it's an unsustainable boom. And I can tell you that the SKIP index has been all over the place during the pandemic. At first, people didn't want to do anything, so there were no skips in the street. That was the period where GDP collapsed. Then we had the working from home revolution, and everybody wanted to convert their lofts into offices and to build conservatories for a bit of extra space and so on. So we had a boom in skips, and at times it did look like an unsustainable boom. There were four in the street, but I think things have settled down now. And the reason I think things have settled down, there's one skip in the street which is a little bit below par, but not too disturbing. The reason things have settled down is I think there is a bit of a return to post-pandemic normality. The giant is awaking again, because the other index I monitor is the station car park indicator, and there's a station car park about half a mile from where I live. It takes people into central London, and during the pandemic, the station car park was no more than 10 or 20% full during the worst period of lockdowns and working from home guidance. And even last year, when there are periods where people were encouraged to go back into the office, it didn't really get much above 40 or 50% capacity. But it's picked up a lot now. I think people are returning to city centre. They are returning to the centre of London. So the station car park indicator is probably now 80 to 85% of normal. People are going back into work. They're thinking a little bit less about conversions and so on in the street. So there are fewer skips around. So I think that's a good sign. Normality is returning. And on that note, I'll hand you back to James. Thank you very much for listening.
Thank you, David. There's certainly some reassuring words there, and certainly a lot to think about. So I'm sure there'll be a few. In fact, there are already some questions. So everybody else, please do consider raising questions. And there'll be certainly a few more coming by the time Mark has finished his presentation. So we now move on to some wise words from our property specialist, Mark Long. So Mark, over to you.
Thanks, James. Yeah, hopefully you can all see the slides. I'd just like to take you through my thoughts for commercial property markets in the UK. And first, I think you have to start by setting the scene in terms of thinking about where the UK sits in the global context, because the global context is really important for the UK market. These are figures from MSCI, and actually in terms of property investment, the UK market is the third largest in the world according to the MSCI, and that's really important, really punching above its weight in terms of population, in terms of the size of the economy, and the reasons for that are just the attractions of the market for overseas investors and their impact on it. Here we've got a chart which shows you the breakdown of domestic versus overseas investment activity, and what you've seen is about half of market activity in the UK is from overseas investors investing in the UK, and it's often the first port of call when you want to invest outside your market. Let's buy a building in London. And yeah, and in fact, I think it's 20 odd years ago now, Reading University did a study of all the transactions in the City of London, and they found that more than half the buildings in the City of London were owned by foreign investors, and that's only increased since then. I don't go through all the reasons, but certainly language is important, the legal framework, the friendliness to overseas investors, transparency, it's all important factors in helping the UK become that very important international market. And I think in a situation where the UK, I'll come on to this shortly, interest rates and yields are higher than other parts of the world, that's dragging in more capital, and that's helping support the values of UK investments, and maybe even putting some pressure, downward pressure on yields, and so upward pressure on values in the short term. I mentioned this before, but let's just think about this. This is some data from CBRE, and it's just looking at prime investment yields across different parts of the UK property market and comparing it to, say, Germany and France. Here are our two main continental partners. As you can see, in every market there, yields are higher, and especially in town centre markets, which we'll go on to in a minute, but which really suffered over the last decade, really, but particularly through the pandemic. And this is interesting because actually London used to have the lowest yields amongst our lowest yields of the world outside Japan, but that's no longer the case. And actually, since Brexit, what we've seen is a change in investment activity. Pre the Brexit referendum, the UK used to account for around about three times, or rather the activity of the next three markets put together in Europe, whereas now it's on about par with Germany and just slightly ahead of France. So people have rearranged their activity and investing far more in their own domestic markets than they are overseas. But maybe that'll change now that Brexit is done and we're getting more clarity around the rules. I think another important point for domestic investors, and this is perhaps what's feeding some of the growth we've seen in the market over the last 12 months or so, is that we're still offering a very high level of yield premium versus other assets, particularly in this case 10-year gilts, and that also has come down over the last sort of 6 months or so as inflation has spiked. We still have 100 basis points more than a long-term average in terms of just current income yield on rents compared to the gilt series historically. So we're cheaper than our European peers. We're cheaper than 10-year gilts. Therefore, we think that actually there is some scope for yields to, if not stay where they are, while interest rates rise slightly more, and perhaps even in some markets come down a bit more as foreign investors come in and price other about the market. Let's then think about what the value journey's been through the whole COVID situation, and I've just indexed capital values across different parts of the UK market. The line with the square definitely is the all property market, and that's about 5% higher than it was back in December 2019. The orange line at the top is the industrial sector, which has been the real winner over the last two and a half years. It really has outperformed all the rest of the market. And the blue line at the bottom is shopping centres, and the town centre retail really has underperformed quite dramatically. That's quite surprising because actually the retail, if you looked at retail spending, that came back very quickly. By August 2020, retail spending was higher than it was pre-pandemic. But where that retail spending has been going is slightly different. It's been directed more at the internet during lockdowns, although that's come back a bit again now. But internet retailing really has taken a step change, and it's taken away footfall from town centres particularly. And the only part of the retail market there you see, and it's the only part of the retail market which is dragging the all retail average above that zero line, is retail warehouses. And that's been the real success story, I think, of the COVID pandemic. People jump in their own cars rather than getting on public transport, go to a car park which is free, go into shops which are large and airy, and even click and collect in those locations, their internet purchases, because they can't bother to wait around for or pay for delivery. So let's look at the industrial sector and think about that. Well, I mean, it's just been this is quite a turnaround from when I first started. When I first started in property, the retail sector was the largest sector. Just under half of all property and institutional portfolios in the UK was retail, and it was scattered across 200 towns across the UK. Today, of the three main sectors, retail is the smallest, and industrial is the largest. We spent sort of 20 or 30 years getting rid of industrial estates and putting housing estates on them or retail parks, and now we're finding that actually the industrial land use is actually the highest land use in a number of those locations now. And part of that has been tenant demand driven, as internet retailing really picks up and people look at their supply chains and how to deal with that. And a lot in terms of investment activity has been driven by people pouring more and more money into the industrial sector and just pushing down those yields now. And if you look at London now, you're sub 3% yields now on London industrial estates, whereas we look at some of the previously lowest yielding parts of the market, which were in town centre shops, they're now around a 7% yield now. And as I said, tenant demand has really picked up, and the real winner has been industrial sector. We've seen record levels of take up in terms of logistics space across the country as a whole. But rental growth really in the southeast has been the strongest by far. It's a question mark about how far can this go. But at the moment, it's really in the sun, and rents are rising, yields are falling, investors love this, and tenants are having to suffer the rises in rising levels of rent. And there could be a bit of a speed bump now coming up in 2023 when we have the rates revaluation, because there's going to be quite a substantial change. And actually, in some locations, rateable values could increase by 40%, and that could in 1 year just have an impact of around a 10% increase in total occupation costs for some of these occupiers. So a significant issue there. Rents have increased quite substantially. Some of the underlying tenants in this market are relatively weak, smaller covenants who haven't seen their bottom line, their sales increase by the same level. So I think a bit of a word of warning there, given the high level of pricing, the high level of rental growth we've seen in the past. But I think we are 11 slides in, and I haven't mentioned ESG yet, but I thought I'd so this is a recent development we undertook in near Heathrow Airport. We developed an old 50s industrial estate into basically net zero carbon. Lots of solar voltaics on the roof. We've got 2 foot of insulation in the walls, so they are ESG up to the eyeballs. We've got batteries in some of the units. We initially appraised this of a 4%, 4.25%, I think it was, investment yield and £13.25 rent. The last, when we actually thought we were going to let it over the course of 18 months, we completed this early last year, and now we're marketing the last unit for £19, and the value is attaching I think it's a 3.25% yield to it at the moment, and it might go down again this month. So it's the way the market's going, and there's a lot of demand for more efficient buildings which have these kind of environmental characteristics and which have lower occupational costs compared to traditional buildings. So I think it's an interesting example of where the market might be going in the future. Office sector, well, this is a bit more difficult to call, I think. We've had a lot of surveys about the future of offices being very glum and bleak throughout the pandemic. I think a number of those surveys now are coming back, and there's a bit more balanced picture in terms of what office demand might be. Here's a survey from Savills showing how office demand has changed over the past few years, and we've seen quite a strong recovery in 2021 compared to 2020 and 2019, which was quite a weak year. But I think it needs to be put in context that actually what we've seen is demand that was held over from 2020 has come into 2021, and actually the government demand is biasing the 2021 number, because they're demanding more than doubled in 2021, and so that's sort of that won't happen going forward. And the key here is, what is hybrid working, home working going to do to office demand going forward? We do think there's been a permanent structural change in working patterns. I'm coming to the office now 3 to 4 days a week rather than 5 days a week. We think there's going to be a lower aggregate demand for offices, certainly in the short term. But I think our view at the moment is that that's actually more going to impact on secondary office centres and back office locations. So rather than having all your back office staff coming in every day, maybe they're going to come in once a week, and so you need a substantially smaller amount of office space than you did before. Conversely, we think there's a trend already listing for more than a decade now of centralising your office demand and your head office activities into the larger cities, and a lot of this is about attracting customers and attracting the right talent. The best graduates, the bright graduates, they want to go and work in vibrant city centre locations. They don't want to go in a business park outside Leatherhead. They want to live in the city. They want to have a good life and entertaining time and actually build a career. And you can't do that working from your parents' bedroom. You have to interact with people. You have to be in the office. You have to learn from people who've done it before. So I think from my point of view, I think the office sector does have a future, and our focus very much is on the bigger towns going forward. But what about all the space out there? Now, the last 20 years have actually seen quite a lot of town centre space being converted into residential, and development rights have done a lot for that. And here's 8 buildings which are currently either been sold recently or on the market, and every one of these at the moment has a plan to be converted to industrial. So there's a new trend which we're seeing in the market now. Out of town business parks, there's not a huge amount of office demand there. The cost of refurbishing these, especially to the new higher ESG standards, are prohibitive. And so we're going to a higher value land use, which in where you've got large car parks and large landscaping can be industrial in some locations. So I think I've talked about this before, but what's the future of offices? Well, I think location is really important. Bigger cities, vibrant cities, where the best graduates want to work, and companies need to attract the best graduates to sustain their future going forward. London and Manchester certainly in there, but we also like some specialist clusters: Cambridge, Oxford, Bristol, even Brighton. We think has a good future. The type of office you've got there is very different now. I think even post-pandemic, we're seeing quite substantial changes. We've had some amenities already in these offices, but we're also now talking about looking at buildings which offer high rates of fresh air circulation. We're thinking about health and safety very much more, and there's some interesting research now done on looking at the productivity of office buildings actually, and how your air quality and your facilities actually increases productivity. And that's a really interesting area which I'm certainly doing research on. So for landlords, what does this mean? Well, in the short term, we think there's going to be less demand. That might focus more on secondary towns, but actually all this amenity space and breakout space means you actually have more space per person probably. Certainly ESG is increasing the costs of refurbishing these buildings, and people want more flexibility and shorter leases. So that's more difficult. And so what does that mean for landlords? Well, it might mean an increased rate of obsolescence going forwards. Quickly counting through the retail sector, I've touched on some of these things already. This is just looking at PMA data, looking at the vacancy rate in different towns. And what we've seen is there's been a long-term increase in vacancy across many towns in the UK. And this has happened. The pandemic has really accelerated that trend quite dramatically. We're seeing well into double-digit vacancy rates now across most towns and centres. My office is just off Regent Street, and I was walking up the street this morning, and there's 18 individual shopping units here, which are vacant at the moment on Regent Street, possibly one of the best retail locations in the UK or in the world, possibly. So we've just got too much space because of the way that consumer spending has changed, because more of the spending has gone to the internet, and more of the spending now is polarizing the market away from town centres, or away from some town centres and towards the internet. And we just have too much space in the middle ground. I think the middle-sized towns and secondary centres are the ones which are really suffering here and will continue to suffer. One bright spark throughout the pandemic through retail parks, where, and I'm touching this before, but what we saw was a very sharp decline in the footfall there throughout all parts of the retail market in the initial lockdown. But since then, your retail parks really have survived quite and traded quite well, and we're just below the 0% average here. So footfall nearly back to post-pandemic levels, which is not bad considering we lost about 1 million people from the UK in terms of EU migrants. So the retail sector as a whole, there are opportunities, I think. I mean, we've both talked about the difference in the market. I think value convenience retail, certainly the internet is driving people into industrial estates, but also it's retail parks, which are really work for click and collect, and the discounters and the food stores who have very low margins. They can't afford the picking of goods and the delivery of goods. They make a loss on that. And if you look at some of the food retailers' accounts, you won't see much in there, which leads you to believe that internet retailing is a profitable activity for them. We've also seen localization. A lot of more local convenience still has a lot of growth there, and that's been a real winner from lockdown as well. At the other end of the market, not all is doom and gloom in the biggest cities and towns. I think destination leisure really has a future, and there's certain town cities where you want to go, you want to meet your friends, you want to have lunch, maybe you'll go to the cinema as well. And there are a smaller number of larger towns which offer that kind of leisure experience, accompanying the shopping, which will really work going forward. And I think we're seeing the emergence of markets which really are, rents have fallen, yields have risen, and then some of them are quite attractive now. Well, in Central London, I talked about Regent Street recently, but it's very reliant on tourists and leisure, and the market really starting to come back now here, and I think it's going to be a tough year for Central London retailers. Probably even with sales going up, we're still seeing depressed tourist numbers. We're still seeing less people in town on throughout the week. And these guys who's if it's 80% of numbers, they're still not making any money because their fixed costs are 80% of their revenue. So in summary, there, I think with a lot of retail, which in medium-sized towns, which just is obsolete. There are some towns with opportunities, I think, but there are far more where it still need to fall further, and rates could be a big issue. In some of these locations, and actually the rates are higher than the economic rent of some of these locations in some towns. Throughout the pandemic, we've seen a lot of PE-backed retailers, CVAing and not paying rents and stuff, and it starts to question the financial covenants of some of these larger multiple retailers who are backed by higher leverage structures. So there's some wariness there, but perhaps pricing is adjusted enough to make that worthwhile. So just to summarise, in the end, I think the market is highly polarised. It will stay highly polarised. Industrial sector, it really is having a fantastic time at the moment, but there might be a speed bump with the rates revaluation in 2023. Retail, the market as a whole is oversupplied, but I think there's real opportunity there. There's high yielding out-of-town retail warehouse, which is quite attractive at the moment. There are some towns and cities where the destination leisure activities will come back, and actually pricing hasn't yet adjusted, so there's some quite attractive, healthy yields out there for those tenants who will survive. And in the office sector, I think it's a bit late to tell, but I would bet that the focus will be on the larger centres and specialist things like Cambridge, Oxford, Bristol. And I think any negative impact on rents, if you've got buildings with well characteristics, which are wired, which have got breakout areas, which have got high levels of air circulation, showers and cycle racks, those ones are going to be well insulated and might even see rental growth over the coming years, as opposed to the majority of stock, which doesn't offer a lot of those kind of characteristics. And finally, I need to finish on a note from our compliance team before I hand back to James. Thank you.
Well, thank you very much, Mark. It's another fascinating presentation. I think repurposing and change definitely is coming to the fore there. Now, David, I can see you have rejoined. Thank you very much. And I'm now actually going to move to the questions stage. Indeed, we have a range of questions already posted, but for all those who would like to raise a question, please do. You can still post the questions. I'm going to kick off with a couple of questions which relate to levelling up. And first one is from David Devereux, and this is addressed to you, David. The second question on levelling up will be to you, Mark. So this to David. Given Gove's levelling up plans, is there any serious additional or new money on offer, or is this just packaging and old budgets?
It's a good question. I mean, I think the context of this, just to be fair to Michael Gove and to the government, is that all this should have been announced in the autumn alongside the spending review, and in the context of quite a lot more infrastructure spending going to the regions. So I think and what got in the way of that was the Prime Minister's problems initially over Owen Paterson and then over the parties. So I think the gap between the spending review and the levelling up white paper has created more of an impression that there's no new money than I think is the case. I think the new money, there is some new money to do with levelling up in the comprehensive spending review. You can argue, and I think I probably would argue, it's not enough and it's not particularly well targeted. Certainly, if you look at what Germany did to level up the old East Germany, we're not really in that same ballpark. But there is money going in. It's just not been particularly well politically coordinated, I think.
Okay, well, thank you, David. Now, I think the next question, I'm going to start with you, Mark, and David, you might wish to add comments. And this is the question from Chris Waits. Will the levelling up agenda and hybrid working and cost of living crisis shift office occupied demand into provincial cities and away from central London? So over to you, Mark.
No, I honestly don't think so. I think there's a lot of stock out there which is tired and is just too expensive and not providing enough return for investors to refurbish into those markets. I think there's opportunities for a small number of buildings in those centres, but I think the trend we've seen before the pandemic, and I think the pandemic accelerated it, is that you'll see demand consolidating into the larger, more vibrant centres, and it's been more like head office demand, where you need collaboration to produce the best result and productivity and those kind of factors. You'll be attracting your customers there. You'll be part of your brand. You'll be attracting your best staff. The best graduates are the ones who are going to deliver your profitability for the next 10 years. It's not your older staff who want to live next to a golf course or work next to a golf course outside of a southeast town or something. I think that the trend is established, urbanised living. I don't think COVID has yet just derailed that kind of city living trend for the younger, more productive folk.
Yeah, and I think Mark, with cost of £100 to £200 a square foot to refurbish a building, these lower rent areas just aren't really going to make it. But David, I mean, from your point of view, do you say, I mean, from a government relocation point of view, I mean, do you see anything different to what Mark is saying?
Not particularly. I mean, obviously we're seeing a little bit of activity in terms of government relocating, but this has been the case forever, relocating some of its own activity. And we've got the this new Treasury hub in Darlington. I know Darlington a bit, and they will welcome it. I don't know whether the officials who go there will welcome living in Darlington, but it's a nice place. But it's an odd message. I mean, you could make the case if you were a government minister that remote working could be great for levelling up because people can be where they want to be. But most of the messaging from the government is that everybody should get back to their offices as soon as possible, which just re-establishes the status quo and as Mark says, the dominance of big cities and the attractive urban locations, as opposed to small towns with not very nice offices. So I don't think they're particularly biting on that. So the post-pandemic is great for leveling up. I think it's a much more traditional regional policy approach that they're taking, an approach which I have to say hasn't worked particularly well in the past. I mean, I wrote a book on the regional divide in the 1980s called North and South, and the same arguments are being used in the white paper, exactly the same arguments as I rehearsed in that book. So I don't think a great deal has changed in this debate, and they're still looking at it very conventionally, I think, rather than seeing remote working as a great opportunity for leveling up.
Okay, great. Thank you, David. Now, I'd just like to switch on to sustainable energy and taxation. So this is another question for you, David. And this is a question: why are there no plans for a windfall tax on energy tax? As this could or would allow tax increase on other hardest hit areas to be deferred or dropped?
Yeah, I mean, I think it's an interesting question, that, because there is obviously a political head of steam which is building in that direction, and we've had BP's results this morning, which I think were quite strong as well. But the reason governments don't like windfall taxes is because it introduces a new level of uncertainty into taxation. It looks capricious on behalf of governments to suddenly slap on a tax in particular circumstances, and businesses hate that, and I think with good reason. So they've been used very sparingly over the years. I mean, the Thatcher government had a windfall tax on the banks in the early 80s. Gordon Brown, when he became Chancellor, had a windfall tax on the utilities, the privatised utilities, to pay for a youth scheme, the New Deal for young people. But they've been used quite sparingly, and the problem is that although inflation should subside, because we want, we'll get a 54% increase in the energy price cap this year, but we won't probably, it'd be highly unlikely to get anything like 54% in the spring of 2023. Although inflation should subside because of that, the rate of price increase, high energy prices might not subside. So you might find yourself using a windfall tax this year and then needing the resources again at a time when maybe there's no longer windfall profits at the energy companies. So I think economically and politically, windfall taxes don't make a great deal of sense, even though they're quite popular with people. So I think that's the reason for the reluctance to do this. I think they should be used sparingly in very special circumstances. I'm not sure we're in those circumstances now. Some people suggest, because the supermarkets had a good time during the pandemic, they should be slapped with a windfall tax as well. But I don't think any of these things make a lot of sense. And they, as I say, they create a new uncertainty for business. They make the UK less attractive for business, I think, if you do these things too much.
Yeah. Okay. Thank you, David. Now, in a way, this is a related question. This is from Julian Berry. House prices romping, interest rates rising, cost of living squeeze. What will be the impacts on the housing markets? Are we in for a collapse?
Yeah, thanks, Julian. Yeah, that's a nice, easy one. And I think the answer to this is that because we're in a different world now when it comes to interest rate changes and the housing market, because the nature of mortgages has changed so much. I mean, when interest rates used to go up, which they did a lot, we're all on variable rate mortgages. We got a monthly letter from the building society or bank to say how much our payments had gone up. Then the bite was immediate. These days, it's people fix and refix. So the feed through from higher mortgage, higher interest rates, higher official interest rates to mortgage rates is much slower. But mortgage rates will go up, but I don't think they'll go up enough to kill the housing market. I mean, house price falls tend to happen when the economy goes into recession, and which is why the pandemic experience was so unusual. And although I think the cost of living crisis will slow economic growth, employment, as I noted, is still pretty strong, which is always positive for the housing market. I think some of those reassessments of life, I mean, Mark talked about, you know, hybrid working and so on. Some of those reassessments of how people are going to live their lives are going to survive the pandemic. So, and that was a big feature in the pandemic housing boom. That, you know, when people were at home, locked down, they went onto onto Rightmove and the other sites, and they looked at where they could have a better life, you know. And I think that demand is still there. Yeah, and if you think about what's happened to the housing market, I mean, it has survived the end of the stamp duty cut. It is still doing pretty well in the context of everybody, I think, being aware that interest rates are going up. So I think a slowdown in both house prices and transactions is likely. I think a fall in house prices of any extent is quite unlikely, despite higher interest rates and the cost of living crisis.
Okay, David, that's interesting. But sort of a curveball question, which coming in from Fergus Laird, is has anybody factored in the impacts of a war in Ukraine on their predictions?
Yeah, I mean, the answer to that, I mean, the governor of the Bank of England, Andrew Bailey, who's been much criticised for his remarks on pay last week, did refer to this. You know, that you know, whatever we think is going to happen to energy prices now, it'll be much worse if there was a war, if there was a Russian invasion of Ukraine, and that is undoubtedly the case. Although, you know, we've had, you know, the periods when we've had conflicts involving energy states before have tended to be, you know, we all think back to 1973 and the Yom Kippur War and the first OPEC oil price increase and so on. But more recently, conflicts involving Russia have not had a lasting upward effect on energy prices. So I think it could be a bit worse. I don't think it would be devastatingly worse, unless, of course, the war spread in any serious way. And, you know, if Western powers get sucked into a war in Ukraine, then obviously, you know, that's bad for markets. It would push up energy prices further. So I think people are looking at that, but I don't think they think it's the most likely outcome. But it's a danger. It's one of the several risks we've got, I think, looking forward into the year.
Yeah.
I think in the property market terms, you might see central London taking another hit from this, because there's quite a lot of Russian wealth tied up in housing and you know, and the spending power of those people in some of the higher end shops there could be another hit to that spending in that area.
Okay, well, thank you, Mark. You've actually just given me a quick segue into a question from Andrew Hynard, who noted your reference to business rates. And so his question, are you confident that business rates are going to be reformed? Or maybe that's an open question to all of us. Or is business rates the sort of concern that you're factoring in?
From my point of view, it's a really big concern, because I think a number of local councils take a lot of money from the retailers at the moment, and those retailers can't afford the kind of level of take of local taxes. A number of the industrial occupiers are not ready for the substantial increase in rates they could see. But who knows? It's been put off a few times now. Will they put it off again? I don't know. But certainly, I haven't seen any studies of what the local authority finances might do if you looked at what the impact of falling, you know, retail rents in each of the different cities does to the rates take, or you know, the impact on occupier markets of the increases in occupational costs for industrial.
Yeah. Okay. And in terms of the prospect, you've already answered the question, Mark, the office markets. This was to Chris Waite's question, but another one in from Howard D'Souza was really referring to the fact that 25% of government roles are going to be placed out of London. And whether you think there's a real catalyst in any of the regional sort of centres or from that move, or is this a vain hope?
I can look at Swansea, Blackpool, Newcastle. You said Darlington, was it? There haven't been major catalysts yet in the last 3-4 decades of them doing this. I think that the catalysts for growth tend to be the new and growing industries. So your tech, your fintech, those sort of things, and they're all, where they cluster together, they can and the clusters is really important, I think, and where they do that, they grow. They feed off each other's ideas and they create better products. Whereas I think, unfortunately, the government doesn't have that same kind of impact.
Yeah. Okay. Great. Thank you. And I'm going to switch over to a couple of final questions over to you, David. First of all, we have Phil Winkles is actually concerned that there's quite a sudden reduction in inflation sort of forecast down the line, and given the pressures on household income, is this really considered to be realistic?
Yeah, thank you. I mean, I think we all have to be a little bit humble about this, because, as I say, a year ago, not many people were predicting the kind of inflation we've got. So the fact that everybody, pretty much including the Bank of England, is predicting that it will drop off quite quickly. And now, I think this is one of those things where if you like, you can have inflation falling, which it should for the reasons I suggested. Supply chain problems beginning to ease, things like the crazy thing that's been happening to second-hand car prices, energy prices still staying high but not increasing at the same rate, should mean that that inflation subsides. But it doesn't mean that high prices subside, in some of those areas. And if you're a car manufacturer, you'd be, and you get you've got the supply of chips back, you're going to look at what's happened to second-hand car prices and think, well, this is a great opportunity to push up our new car list prices. So I think higher prices are here to stay. I think it will take some time, longer than the Bank of England suggests, before inflation gets back to a very low level. I think we're in for a couple of years of not 7% inflation, but 3 or 4% inflation, which will still maintain the squeeze on incomes, I think, because I really don't believe that there's a new power of negotiation there in the labour market. I don't think we're going to get a wage price spiral. So I think it's going to feel uncomfortable for some time, and the drop back in inflation will not be as sudden as the Bank of England hopes. So I think it's a good point. And as I say, we've got to be humble about this. I mean, the danger is that this does become ingrained. People are talking about inflation, and businesses are talking about inflation in a way that they haven't done really for many decades. I mean, even in the 2 blips of inflation we had in recent years, in 2011 and 2008, when oil prices went up very sharply, I don't think anybody really thought then it was the return of the 1980s or 1970s, whereas there's been a lot of talk about that, and that means that people are more accepting of the idea that prices go up, and that you have to anticipate price increases, and businesses have to push through price increases because of cost price and so on. So I think we're in greater danger of it becoming ingrained than we have done for some time, and the risk is it doesn't subside as fast as the official forecasters, including the bank, hope it will do.
Okay, great. And Mark, I mean, presumably you're factoring in the fact that interest rates are not going to impact on your fund management predictions.
Yeah, we're very much following kind of the market expectations that rates won't go much above, if above 1.5%, and so that property retains its attractiveness. But if we like to, we could always look back at history and say that property's a reasonably good hedge of expected inflation. And back when I started my career many decades ago now, bond yields, gilt yields were actually higher than property yields, because inflation was higher, and you were getting your rents were rising year on year and protecting you from that. So there's lots of reasons to be investing in property and not to be that pessimistic about the future of the market, even if we're not going to get massive levels of economic growth to support occupational demand.
Great, thank you. And now I'm going to finish off with one final question. This is more of an international question. This is from Richard Clark. with China growth dropping to 5%, what do we think of the prospects for India? Again, the sort of the the big sort of query here is obviously China taking over the world, but what about India, especially where we have the UK as close sort of historic links?
Yeah, I mean, one of the it's a very good question, and I'm optimistic about India. I mean, some people say that you get very optimistic about India, and all that optimism drains on the car journey into town from the airport, depending on which city you've landed in, because you see the chaos there at first hand. So it's a chaotic country, but it's a country with lots of good prospects. I mean, India's demographic advantage is enormous. China has a demographic and age profile of its population very similar to most Western countries. In other words, an aging population because of the one-child policy and so on. India has a very young population. 75% of the population of India is under the age of 35, and they've got enormous potential there. I think they are, in the way China is now coming up against a lot of resistance in the West, probably started by Donald Trump, but it's been continued by Joe Biden in a way that India is not. So India is set fair in terms of the international context for growth. So I'm optimistic about India. I think India will grow faster than China over the next 25 years. It won't become bigger than you go back to the 1970s, and the Chinese and Indian economies were pretty similar in size. And now China is a lot bigger than India, of course. So it will take time for it to catch up. But I think I'm optimistic. And the tragedy of UK-India relations is that we should have, a much closer trade and investment relationship than we do. And there's quite a lot of Indian investment in the UK, of course. Tata and many others. But in terms of trade, we are well down the list of India's main trading partners, and we should be a lot closer to that. But the government is trying to negotiate a trade deal. The quid pro quo that would probably mean easier immigration arrangements for Indians wanting to come to the UK. But I think they'll probably concede that. So I think the potential is good, and it's good that we are going to be tied more closely to India if we can do that, because I think there is enormous potential, and it's a good optimistic note for the last question, if that is the last question, James. So yes, I think it's a good there.
It is, David. Yeah, I'm afraid there's no time for more. And Mark, there are lots of following questions for you as well. But I'm afraid, and regrettably, really, everybody, ladies and gentlemen, it's time to wrap up. Wrapping up what has been a very insightful and thought-provoking session. So to summarise, the UK economy is back to its pre-pandemic levels. The recovery should continue, but there are increased costs, ongoing restructuring, and geopolitical headwinds lie ahead. And it's pleasing and comforting to hear that the prospects for commercial property markets, whilst very polarised, are positive overall. So this just leaves me to thank both David and Mark for sharing their valuable insights and their candid opinions. So thank you very much. It certainly helps shape my thinking, and I hope it's given each of you some food for thought. And finally, thank you everybody for tuning in today and for taking time out of your busy schedules to join us. Hope you all have a productive day ahead, and thank you.